Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in today's video we're going to be talking about Tattooed Chef and specifically around their recent Q3 earnings release. We're going to look in detail at what they meant and ultimately what that means for Q4 and for the valuation of Tattooed Chef going forward. I recommend checking out my previous video on Tattooed Chef which I released just before the Q3 earnings where I looked at what we could expect from the business and ultimately what that means for the valuation. If you're new to the channel and you like investing related content, then smash that subscribe button. And if you like these detailed stock analysis videos, then please smash the like button as well. It's so helpful in pushing the channel to a wider audience. As always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So last week, Tattooed Chef released their Q3 earnings report. And as expected by the guidance in the preliminary results, revenues totaled 41 million or 65% growth on the Q3 period in 2019. They reported gross profit of 3.8 million. Which was 16% down on the same period in Q3 2019, and EBITDA of $1.5 million, which was down 35% on the Q3 period in 2019. Now, initially when I first saw this, I was actually a little bit disappointed, and especially because if you'd seen my analysis I did in my previous video, I was expecting EBITDA to be much closer to the $5 million mark. What I'd ultimately done in my analysis is taken the margin that the business had delivered over the first half of the year, and applied that to the preliminary guidance on revenue which we had, and that gives you an EBITDA of around $5 million. This felt quite conservative because when you look at 2019, the EBITDA margin the business generated in the first half of the year was much lower than that in the second half of the year. So when I first saw this, I was a little bit disappointed, especially when you look at that $1.5 million of EBITDA as a 3.7% margin for the quarter. That compared to the $7 million generated in Q1 at a margin of around 41%. Now upon seeing this, I took it upon myself to do some digging and understand why the margin had decreased so much and what was going on. Is it something that we need to be worried about? Or are there things that we as investors need to keep an eye on? Now I'm going to go into the detail in a second, but actually what I saw didn't unduly concern me, and in fact it gave me some confidence for the business. Ultimately, if what management is saying is true, and if the business does continue to perform in line with how it has done historically, I actually think this is setting up the business for a very good Q4, and ultimately all of that's really positive for valuation. So looking into it, the key reasons why the EBITDA has fallen and why the margin's fallen so much is down to two primary reasons. So the first reason is due to a promotion which was run across around 450 stores to boost the brand image of Tattooed Chef and ultimately increase the brand awareness. The promotion was focused around the acai or acai berry bowl, please don't murder me for the pronunciation of that, and ultimately cost $1.4 million. So that accounts for around 3.5% of the margin lost. But more importantly, it's a brand building exercise. Yes, whilst it's not great for EBITDA in that quarter, what it should do is it should drive further sales, incremental sales in future quarters. And that's so positive for revenue going forward. As is always the case when running promotions like this, there is the risk that consumers get used to the product at its discounted price and it to be sold has to be sold at a discount. However, from what I understand and from what I'm reading at this point in time, that's not the perception amongst consumers at the moment. However, this is something I will continue to keep a close eye on. Now the second reason is due to a slight shift in the marketing strategy, focusing more on the branded products rather than the private label side of the business. And ultimately that resulted in around $600,000 of incremental costs, or around 1.5% of margin. Again, this is not something that worries me or feels long term because it's again a brand building exercise. It's pushing the brand to a wider audience, which ultimately should drive incremental sales. Now during the Q3 earnings as well, we were given guidance on what we should expect for Q4. Now we were told to expect around $39.1 million in sales. What this ultimately means is management do believe that the overall sales outlined in the investor presentation will be hit by the company. Personally, I still think this may be a little bit conservative. Perhaps management are guiding us for a lower number so they can beat it in the Q4 earnings. Here's my rationale for that argument. In 2019, Q4 was the quarter with the largest sales overall. In Q3 this year, the company spent a lot on marketing that should ultimately drive a greater awareness of the brand and ultimately further sales. If we don't see that increase in sales in Q4, then have those marketing initiatives really actually worked? That's something that's really important to consider and important to keep in mind. So personally I do think and ultimately hope that Q4 is an outperformance on a sales basis for Tattooed Chef. Now obviously this is all dependent on the economic environment that we're currently in and also is impacted by the ongoing health crisis. Management also guided us for a Q4 expectation of EBITDA to be around $2.5 million. Now looking at this on an overall basis then, assuming that $2.5 million in Q4, this would imply an overall EBITDA for the year of $13 million. Now if we compare that to the investor presentation, we were guided towards around $17 million. So that does imply a $4 million miss at an EBITDA level versus the investor presentation. If that is how Q4 played out, I think I would be a little bit disappointed. It would seem to imply that the incremental cost that the business had incurred during this quarter did not result in any uplift in sales. So let's hope I'm right in the suspicion that actually the business could outperform that and could deliver a higher revenue number. When you take a step back and think about what this means for the valuation of the company, I think it's still really positive. Investors seem to value this on an EV sales basis rather than an EV EBITDA basis. I think two reasons for that: the high growth in sales that the business is delivering, as well as the immaturity around the cost base. So with that being said, personally I don't mind if there is a miss at the EBITDA level, as long as there's strong sales growth and potentially and hopefully outperformance of that sales figure. I do think if they can outperform in Q4 on a sales basis, that will be received very well by the market. And ultimately, I do still think that the valuations and the share price estimates which I outlined in my previous video do still stand true here. So for me, I think it's going to be a really exciting Q4 and we'll keep a close eye on developments at the business. So thank you so much for watching. If you like the video, please smash the like button. If you're new to the channel and you like investor related content, then please smash that subscribe button. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting hearing everyone's different perspectives. But thank you so much for watching, and I'll see you in another video.